Hello and welcome to CN Professional Institute. We are still looking at the question and answer session. In the previous video, we solved some questions, about 3 questions on IAS 19 employee benefits. Now in this video, we are going to continue and solve more questions, right? But if you've not watched the previous videos, I recommend you watch because these calculations or computations will be based on the previous videos, right? So if you've not watched the main lecture on IAS 19, and in the first part of the question and answer session, then I recommend you do so because it will help. Let's continue with question 12. So question 12 says CNPLC, a public limited company, agrees to contribute 5% of employees' total remuneration, key here, of employee total remuneration into a post-employment plan each period. And the year ended 31st December, so this is a year end. In the year ended 31st December 2019, the company paid total salaries of 10.5 million, a bonus of 3 million based on income for the period was paid to employees in March 2020. The company had paid 510,000 cedis into the plan by 31st December 2019, and the requirement is calculate the total profit or loss expense for the post-employment benefit for the year and the accrual which will appear in the statement of financial position at 31st December 2019. So looking at this question, you realize that this is a defined contribution. Okay, a defined contribution, not a defined benefit, where we have our present values of PV of liability, fair value of asset, we have our service cost, payment to the plan, contribution paid out, and stuff. This is defined contribution because the obligation is to pay only 5%, right? And when we are done paying 5%, that's all. The obligation ends there, right? Okay. Now they have to pay 5% of the total remuneration here, right? They have to pay 5% of the total remuneration, right? Okay, then we are told that this remuneration here has the salary. So it says as at 31st December 2019, the company paid total salary of what? 10 million. Sorry, 10.5 million. Then a bonus. You see, look at it. It says a bonus of 3 million based on income for the period was paid to employees in March 2020. The year end is 31st December 2019. So you might think, okay, this bonus should not be part of the 2019 financial year because it was paid in 2020, right? And we are paid the extra for 2019, December 2019. So I think, okay, it's not part, but it's really part. Do you know why? If you do the bonus was paid, the bonus of 3 million was paid in 2020, we're told that it is based on income for the period here. Based on income for the period. So income for what? 2019. It was based on income for what? 2019. But just that it was paid in 2020, March 2020, right? So per the Accra concept, it was earned in 2019, and we have to record it in 2019, even though it was paid in what 2020. I hope it's clear. So we have to record it in 2019 because it was earned in 2019 and was part of the income. It was based on the income for 2019. So we have to record it in 2019, right? Good. Just that it was paid in 2020. Okay. So what is the total remuneration? We have two. We have the salary and what the bonus. Okay. Salary and bonus. This will be the total remuneration. Okay. So our total remuneration. So our total remuneration. Okay, let me. So the total remuneration. With the total remuneration, the salary. Okay. What the salary is 10.5 million. Right. So this is the salary 10.5 million. Then the bonus. The bonus is 3 million. Good. So this will be, if you sum all, we are going to have a total remuneration of, because remuneration is the total payment they are making to them. So when you add all, you have a total remuneration of what? 13. So we have a total remuneration of 13,500,000, right? 13,500,000. And this will be the total remuneration paid to them, 30,500,000. So this is the total remuneration paid to them, including the bonus and then the salary. Then we're told that the entity agrees to contribute 5% of the remuneration here. 5%, okay, of the total remuneration into the plan. So their only obligation to pay the 5%. Okay. So they have to pay 5%. So their expense will only be the 5%. Okay. So that their only obligation is the 5%. So that'll be the 5% by the what? The 13.5 million. Okay. That'll be their only obligation, 30% of, sorry, 5% of the 13.5 million. That's all. And that'll be their only obligation. Okay. So you just have to, they have to look at the 5% of the 13.5 million, 13.5 million, and that will give us 675,000. So this is 75,000 is the expense. That's the 5% of the total contribution. So that's the expense they have to record. That's the payment they have to do into what the fund. Okay, that's it. But if you come here, if you look, come here, it says the company had paid 510,000 into the plan by 31st December 2019. So as at the year end, they have paid only 510. I'm following. So that's the cash payment. So for the cash, they have paid how much? 510,000. That's the amount they've paid. So you see that they've not paid all. So their liability will arise. I'm following. So what will be the liability or the accrual? That's what the question said we should do as well. So the liability will be the difference. Okay, this figure here, the 675,000 minus the 310 minus the 510,000. So the 675,000 minus the 510,000, and then that will give us 165,000, if I'm right. Yes, 165,000. So 165,000 is the, so here's 5, here's 6, and here's 1. So this is the liability because they've not paid all, right? Out of the 675,000, they paid only 10,000, and they paid only 510,000, right? Out of the 675,000, they paid only 510,000. So there'll be a remaining liability. Okay, so that's all. So the first question, you should calculate the total profit or loss expense. So the total profit or loss expense is what? The 675,000. That's the five. So the first requirement is we have to look at the total profit or loss expense. And the total profit or loss expense is what? The 567,000. Then the next part is and the accrual. The accrual is what? 165,000. So if you want to use entries, debit and credit entries, what do? You debit P&L, right? P or L with the total expense 675,000, and then we will credit our cash. Okay, because that's at the year end, so credit cash of how much? The cash paid was 510,000, and then the remaining difference, the remaining credits will hit liability. So credit liability of how much? 165,000. So this is the entry. If you want to use debit credit, this is the entry. Debit P&L 675,000, credit cash or bank depending on how they paid it, cash or bank, 5,110, and then the difference, that is the accrued employee expense, 165,000. So as soon as the entity is done making this payment into the plan, their responsibility ends. They don't have any obligation again because this is a defined contribution. Let's continue and look at question 15. Okay, so let's look at question 15. Question 15. Question 15. Right. This is Golda operates a defined benefit pension scheme for its employees. As January 2021, the present value of the defined benefit obligation was 5 million and the fair value of the plan asset was 5.7 million. Equivalent values at 31st December 2021 were 5.94 million and 7.1 million. 5.94 million, 7.1 million. For the year ended 31st December 2021, we have current service cost. We have the interest rate applicable to the net. So if you apply to the net, 3% contribution to the plan, 2 million. Then 800 was paid out to former employees of Golda. The present value of future economic benefits in relation to the plan as 1.1. Immediately you hear the present value of future economic benefit or refund, what comes to mind? Asset selling, right? Because we said with the asset selling, we have to compare the net assets with the present value of future economic benefit or refunds associated with the plan. You should compare the two and pick the lower, right? So whenever you do your net asset, you do your defined benefit plan, you do your DBP, and it's an asset, then don't forget to do the asset selling test. And the requirement is calculate the amount of remeasurement. Yeah, we'll follow the question. To be recognized in other comprehensive income in the year ended 31st December 2021. Right, so let's do our normal thing and then we will get to know the amount to be recognized. Okay, so we start. So here we have the plan assets and then the liability, both at the opening and both at the beginning and the end. So let's do it separately. You can put it together. Let's do it separately, and then when we are done, we'll do the asset selling test. Okay, so let's start with the defined benefit obligation. So the defined benefit O, the defined benefit obligation, and you bring the CD sign up there. Okay, okay. So let's work in thousands. So we start with the opening balance. What is the opening obligation? It's 5,000. I'm sure you can see that. It's 5 million here. If you come here, okay. As at 1st January 2021, we had what? 5 million as the opening obligation. Okay. Then, so we are doing the only liability. Then the interest rate is what? So we should apply the interest of what? 3% on the net, which is the same as applying the 3% on the obligation and apply the 3% on the asset. It will give you the same net. So when it says we should apply 3% on the net, you can still equally apply it on the asset and then the liability, right? So 3% of 5,000 will give us 150, which is interest expense. Then we have, what do we have? Then we have service cost. Okay, service cost of 1.5 million. So service cost 1.5 million, which will be 1,500 with the 3 zeros up. Then we have contribution into the plan. Okay, so this is the service cost this year is here. Let me underline, this is the service cost and then contribution to the plan. We said contribution into the plan does not affect the liability. It doesn't affect the liability, affect only the asset. Then we go to the next one, which is 800,000 was paid to the former employees of Buddha. So contribution, oh sorry, benefit paid 800,000. So I'll eliminate this. So we have 800, which will reduce the obligation and the asset. So I think that's all. The present value of the refund will be used in computing the asset selling. So we have this one here. So we have 5,000 plus 150 plus 1,500 minus 800. Let's do it and get our expected value. So the expected value will be, so these are expected what value. Then we'll compare it with the closing. So here we'll have expected value of 5,850, 5,850,000, right? So this is our expected value. Then let's go and compare it with the closing and see if we have a loss or gain. So what the closing is here, it is equivalent values as at December 2021. Okay, the liability was 5.94 million. The liability was 5.94 million. The asset was 7.1. So we bring it here. It is 9 million. 9 million. Sorry, 5 million 940. 5 million 940 is the liability. So when you do it, what has happened? Can you see liability has gone up? So the difference is the remeasurement loss. What the remeasurement loss? The difference between this figure here, the 5,850 and then the 5,940. So the difference is 90. And this 90 is an increase. So we said liability has increased. And when liability has increased, this one become what? A loss. Okay. So it's remeasurement loss. Liability has gone up, which is a remeasurement loss. So we are done with the obligation. Let's go and do the asset. So the defined benefits asset. Okay. Also, we are working with three in the Ghana cedi. Okay, and then we are working in thousands. So you bring them into bracket, and then that. Now, what is the opening? If you look at this one, what is the opening? So what is the defined benefit asset? So let's go and look at the opening. So you see the opening. The opening is 5,700. I'm sure you can see it. That's 5,700,000. Okay, I hope it's visible. So we have 5,700,000 here, the opening asset. Then the interest rate will be on it. So let's do the interest. Okay, equally you can do the net. You can do the net. Okay, interest is 3% on the 5 on this opening figure. So multiply 3% of this opening, and that will give us 171. So this is interest income. Then what else affect the assets? We have contribution to the plan. Okay, contribution into the plan. What's the contribution to the plan? So as I said, you can put the two together. I'm sure now you know how to do the net. So the contribution to the plan is 2 million, which is here. This contribution to the plan. Oh, sorry, not this one. This one, 2 million into the plan. And then benefit or cash paid out to the employees that have gone to the employees. So benefit paid out. Okay, benefit paid, and then the cash paid out or the benefit paid out is 800,000. Okay, so we are done with the asset as well. We have the opening 5,700, interest 171, contribution is 2,000, cash paid is what, 800. So let's do the arithmetics here and get the expected. So we are going to have expected value, and then we'll compare it with. So what's the expected? What's the expected? So the expected is 7071. I hope you got this 7071. This plus this plus the 2,000 minus the 800. So this expected. Let's go and compare with the closing. Let's compare it with the closing. We have the closing. So what's the closing in the question? With the asset, the closing is what's the closing at here? Okay, 7.1 million. This is the closing figure. 7.1 million. So it's very simple, but I would urge you to do the net. Okay, do the net as well, so that you really get to know how it is. It's very simple. We've solved, or we've done it in the in the previous, the first video on the question and answer session. We use the net to compute the stuff. So this is the closing assets. Okay, 7,100,000. Okay, so 7.1 million, which is 7,100. 7.1 million, which is 7,100. So the difference here is our remeasurement loss or gain. So what's our remeasurement loss or gain? Remeasurement loss or gain. And the difference is 29. Now this 29, is it increase or decrease? You realize that the expected is 7,071, but the closing is 7,100. So asset has gone up. And if asset goes up, we say it's a remeasurement gain, and asset has gone up. So increase in asset is a gain, increase in liability is expense. So if you come here with the liability, it has increased further, so we got remeasurement loss. With the asset, it has increased, so there's a remeasurement gain. So you hope you know in your OCI, you have to net the two. This remeasurement loss, you net it against the remeasurement gain, and that's what you take to your OCI. So we'll do the extract. So we are done. We are done. Let's see our net. So here, because I'm doing it 111, or I'm separating the obligation from the asset, let's do the net asset or liability at the end. Okay. So the net, let's check. If you check the closing, the um closing liability is 5.94 million, which is here. This one, this is a closing liability, and the closing asset is 7.1. So we said to get the asset selling, we have to compare the net asset or net liability. Okay, and here you realize that we are going to have net asset. Why are we going to have net asset? The asset is bigger than the obligation. I following. So the defined benefit asset in the question is 7,100,000. 7,100,000, and then the obligation, the defined benefit obligation is 5,940. That is the 5 million, 5.94 million. That's the 5.94 million, right? So you compare, we said to do the asset selling, compare your asset with the obligation. If the asset is more than the obligation, that's if you get net surplus or net asset, then you have to compare the net assets or the net surplus with what the present value of future economic benefits or refund. The lower is what you record, because we said we cannot record asset above the lower of the two. So we compare the net asset with the present value of future economic refunds and we pick the lower. That's the asset selling. Okay, so our net asset, let's find the difference between the two and get the net asset. Okay, so when you subtract, what do you get? You get that's the 7,100,000 minus the 5,940,000. So the difference will be 1,160,000. That's what I've gotten, 1,160,000. So this is the net and it's a liability. Okay, so it's a net sorry, it's an asset. Sorry. So this is a net and it's an asset. Okay, so that's our net asset. Our net asset. So our net asset is 1,160,000. That's 1,160. We say we are working three zeros. So this is a net asset. Then you come and compare it with the refund. Okay, what is the PV of the refund or the future economic benefit? So the future economic benefit. Okay, so future economic what benefit? So the future economic benefit, the present value of the future economic benefit or the refund is 1,100,000. So we have this one as the refund, 1,100,000. And when you compare, what is the lower? So what is the lower? So you realize that there's a lower, the lower is the 1100. So this is a lower. I following because we said that the net asset is 1,160. Then the present value of future economic benefit or refund is what? 1,100,000. That is 1,100. We say we are working three zeros. So let me eliminate the zeros. So the net asset is what? 1,000,000. The net asset is 1,160. And then the future economic benefit is what? 1,100. So comparing the two, the lower is the 1,100. So that's the lower. So this is the value that we are going to record for our net asset. This figure here, where we are going to record as our net asset in the books. And you realize that there's a further remeasurement loss. Are you following? There's a further loss, a further remeasurement loss because the asset has reduced. We are recording a lower figure. Are you following? So there's a further remeasurement loss of what is it? The difference between 1,160 and then the 1,100, which is 60. So there's a further remeasurement loss of 60 because an asset has reduced in value. Our net asset that we computed was 1,160, but the future economic benefit was 100. So we recorded the lower, which is the 1,100, and that led to a further loss, a further reduction in the asset value of 60. So we'll take that one to OCI. So that's it. So in the final position, we'll record this figure as our net asset. Don't forget, we'll record the 1,100 as the lower as the net asset. Let's go and do the OCI, the requirement of the question. So if you look at the other comprehensive income, right? You should look at other comprehensive income. So let's do the OCI. OCI. Okay, so other comprehensive income. So the main requirement is OCI. OCI, we have to look at all the OCI values. Let's go and start with the assets. Here we didn't do the net. I follow. We didn't do the net. So we have a remeasurement loss or gain from the asset and then the remeasurement loss or gain from what the liability. And then we also have a remeasurement loss or gain from the selling, from the asset selling. So we have to pick the three. If we've done the net, we would have just had one for the asset and liability and then one for the selling. So if you come to the liability, we had a remeasurement loss of what? 90. So let's go to the OCI. We had remeasurement loss from the asset. Remeasurement loss and this loss is from the liability. Are you following? It's from the liability. Okay. How much is it? It was 90. It was 90, right? Okay. So we had remeasurement loss from the asset. I'm sorry, from the liability. It was 90. So let me put this in brackets. 90 is a remeasurement loss. Then if you go to the asset gave us a remeasurement gain, this figure of what? 29. So the asset was a remeasurement gain, which will reduce the okay, so let's shift the OCI to the next page. So we said we had a gain from the asset. The asset give us a gain. So remeasurement gain, and this one is from the asset of 29, and that's a gain. So we should reduce the liability. So we add, and then we had the further gain from the further loss from the asset selling. After doing the asset selling, yeah, we got a further loss of what? 60, because we said the asset reduced in value. So there's also a remeasurement loss, and this one is from the asset selling. It was from asset what? We did the asset selling test, and we got a further loss of 60. Okay, so a loss from the liability 90, a gain from the asset 29, and then a loss from the selling 60. So when you do it, it's a net loss. The total loss is so total remeasurement loss. So we have a net remeasurement loss of what is it? 121, a net loss of 121, and that is the OCI stuff. So that is a net remeasurement loss. 9 minus 90 plus 29 minus 60. So that's how we go about this question. That's as simple as that. So here, this question requires us to do asset selling, and we perform the asset selling test. Okay. Okay. And I'm saying if you're using the net method, you realize that if you compare the asset and liability together and do everything one, your net from the asset and liability will be the two, the minus 90 and then the 29. So that would have given you a single figure. Okay. But we did the individual. We did the asset together, we did the liability, then we came to do the asset before we did a comparison. So we had one remeasurement loss from the liability, a remeasurement gain from the asset. But if you're using the net, you realize that the asset and liability will give you a single figure. That's the net of what? The 90 and the 29, which would have been still a loss, right? Okay, so you can apply the net to do that. Let's look at question 23. Okay, so let's look at question 23. Question 23. It says the graft has a defined benefit pension plan required. Using the information below, prepare extracts from the statement of financial position and statement of other the statement of comprehensive income of the graft, together with a reconciliation of plan movement for the year ended 31st January 2018. Ignore taxation. So we have the okay. Before that, let me zoom the question down for you to maybe take a shot before we continue. I don't know if it's clear enough. Mm, okay, so there's it. So just from here, so it's the main question. So you can have a shot of this one here. So this is the main part. Okay, so that's the question. Okay, so we can now continue. So we are given the plan assets were 4.1 on 1st February 2017, and plan liabilities at this date were 4.8. Okay, so yeah, you realize that their year end is, you see, their year end is 31st January, right? Which will mean that the new year will start from 1st February. Okay, so 1st February is the opening um balance. The year end is 31st January, and so the opening year or the beginning year will be 1st February. So these are the opening balances. The company paid a contribution of 680 in a lump sum on 1st February 2017. So that's opening. So in this case, the contribution was made at the beginning of the year. So with the plan asset, they paid this amount at the beginning of the year. And I told you the previous ones we did, the assumption was that the contribution into the plan and then the payment out of the plan were done at the year end. Those were the assumptions. But I said if contribution is paid into the plan at the beginning of the year, then that contribution also earn interest. So in that case, we even have to add the opening asset value to the contribution to the plan before you compute the interest, right? Because it was paid at the beginning of the year, and so that will also earn interest. That's when you go to the asset side. Okay. Then benefit paid out to the employees amounted to 440,000, were paid in two equal amounts. Were paid in two equal what? Amounts. Two equal amounts. On 31st January 20 and on 31st July 2017, 31st July 2017 and 31st January 2018. So can you see the payment? The benefit paid out was not done once, it wasn't done at the end of the year. It was done somewhere um in two parts. Some midway, and then the last one was um somewhere at the end of the year. And then we're giving the rate. The yield on high quality corporate bond was 6%, and the actual return on the plan asset was 282. The actual return on the plan asset was what? 282. So we are going to reduce this figure by the interest. Okay, we'll look at the interest we've computed, and then we'll less it from this one to get the remeasurement loss or gain. So we'll get there and then we'll look at it. And we are told that current service cost can be calculated as 4.2% of wages and salaries in the current year. The wages and salaries expense is 5,900,000, which is like you do it like 5.9. That's what it means, right? So 5,900,000. Then we were told that the actuary value the plan liabilities at 31st January 2018 as 4.95 million. So this is the closing value of the liability. Okay, so that's it. So the requirement is, since we have to look at the extract together with the movement. Fine. So let's start with the defined benefit obligation. The defined benefit obligation. Okay. So define benefit obligation. So let's start with the defined benefit obligation, and then we are working, let's work with 3 zeros. Okay, so for the sake of convenience, let's put 3 zeros up. Okay, now what is the opening balance of the obligation? So the opening balance is, so the opening balance of the obligation is 4,800, 4,800,000, and then it's here, the 4,800 is here. Okay, This is closing for 800. Then we have interest. So let's calculate the interest. And as I said, this is a liability. See, look at the benefit paid out. The benefit paid out. Let's come here. I told you that in this case, the benefit paid out, okay, the benefit paid out, it was in two parts. We had one on 31st July 2017 and the other on 31st January 2018. So it means one is at the end, right? And said it was in two amounts, two equal amounts. So if you divide this for 40,000, okay, if you divide this for 40,000 by 2, you get 220,000. And with the 220,000, one was paid on 1st July 2017, and then the second 220 was on 31st January 2018. So you realize that, okay, do you know that benefit paid out reduce the obligation? Yes, and I'm saying if the benefit paid out is at the beginning or midway, that element paid will not attract interest. So we have to take that portion away before we calculate what the interest. So normally this is how the interest will be. The opening balance, the 4,800 will earn interest. But like we are saying, okay, out of this 4,800, okay, it didn't stay with the entity for the whole year. Benefit paid out was done along the year, so we can't compute interest on the whole 4,800. But half, if you look at it, half was paid on 1st July 2017, which is midway through the year. Because the opening year end, I mean the year starts in February. So on 1st February. So February, March, April, May, June, and then 31st July, 6 months. So along the way, midway through the year, they paid 220 benefits to what? The employee. It wasn't paid at the year, it wasn't paid at what? The year end. If it were to be paid at the year end, then it would have just computed the interest on the whole 4,800. But this was paid somewhere midway. So that would reduce the balance. Are you getting it? So we have to do it into parts. So with the interest, the first part, okay, we said so we can do it in two parts. So what will be the interest from February, from the 1st February? Are you following? So from February to um the July, February to July, are you following? So from February to July, how much will be or what will be the balance? Are you following? So from February to what? July, you see the balance will be the whole 4,800 because it was 31st July that the amount was what paid. I following. It was paid on 31st July 2017. So from February, 1st February to 31st July, the interest will be on the whole 4,800. I following. So in that case, the interest rate is what 6%. It's in the question. So it will be 6% times the whole 4,000,000 what 800. I following. Then times 6 over 12 times 6 over what 12. So multiplying 6 out of what 12. This is how we are going to get our interest. I hope you are following. So this is how we are going to get our interest for February to July. Because we said February to July, we've not paid any benefit yet. It was paid on 31st July. So we said the whole amount, the whole 4,800 will earn the interest. I mean, it will command the interest, right? So we'll charge interest on the whole 4,800 from February to what? July. Okay, so we have 6% of the 4,800 times 6 over what? 12. What would this interest give us? It will give us 144. So 144 will be the interest from February to July. From February to July. Okay. Then what about from August to, so we are still calculating the interest, but we splitted it. So from August, okay, to December, okay, it's February the following year. So August to February the following year, that's the year end. August to February the year end. What will be the interest? Now we said, okay, from 30 or on 31st July, we paid 220. Don't forget the 220. He said this 440 was paid in 2 equal installments. Are you following? It was paid in 2 equal installments. So if you divide, you get 220. And we are working 3 zeros. So I've taken the 3 zeros away. So 220 was paid on 31st July 2017. And then the remaining 220 was paid on 31st January 2018. So from 31st July 2017 or from 1st August 2018, okay, because we've paid benefits to the workers, it will reduce the opening what, or it will reduce the obligation. Don't forget we said when we pay, okay, it reduces what, payment out of the fund, okay, or benefit paid out reduces what, the obligation. So we expect that to reduce the payment, that 220 payment. We expect it to reduce the opening liability. And if the opening liability is reduced, interest will also be reduced. So that will be like the 6%. Okay. That will be the 6% multiplying. Now it won't be what? This time it will not be what? 4,800 again. But it will be the 4,800 minus the amount we've paid out to reduce the balance. We've paid 220 out. So from, if you look at from August 2017 to February 2018, we expect this opening balance, the 4,800, to reduce by 220, which is what? 4,580. So we have what? 4,580. That will be the balance left from August to February. So it's 4,800 minus what? 4,800 minus the 220, and that will give us 4,580. So this is the balance, or this is the balance that will be from what? August to what? August 2017 to February 2018. August 2017 to February 2018. So the opening balance will reduce because a payment was affected there, and that will also be times 6/12. Because why 6/12? Because it's from August 2017 to February 2018, right? And this will give us 137 137.4 137.4. Okay, so the interest was done in two parts. We didn't put everything together as we have been doing, right? We said with this one we have to split it. Why are we splitting it? Because they have made payment midway. Okay, and we said if payment is made midway, it has to reduce the what, the opening balance. And when opening balance is reduced, interest also what, reduce. So we said from February 2017 to July 2017, we'll have the whole 4,800 with us. So for that one to attract the whole, the interest will attract the whole 400 what, 4,800. So the whole 4,800 will carry the interest, but it's for only 6 months. But from August 2017 to February 2018, we have paid employees. So that has to reduce the benefit. So the benefit, we paid employees, and so we expect the obligation to what, reduce, the opening balance to reduce. And when the opening balance reduces, okay, that also reduce the interest. That's why we reduce from August to August 2017 to February 2018. We reduce the balance. by 20. So from August 2017 to February 2018, the whole balance will not carry interest. Are you following? The whole balance will not carry the interest. It's supposed we have to less it. Okay. So that how we get the interest. Then we continue with the service cost. Okay. So what's our current service cost? So what the service cost? We have service cost of what the service cost. The service cost is it says is 4 point. Yeah, if you come here, we're told that the service cost is what? Current service cost is 4.2% of what? The basic salary. And we're told that salaries amounted to what? 5,900,000. Right? So our service cost is we have 4.2%, right? Multiplying the 5,900, and that will give us so 4.2% of 5,900, and that should give us a figure of 4247.8. So we have 247.8 as the 247.8 as our service cost. 247.8. Okay, then we now come to the benefit paid out. Benefit paid, how much did we pay? We paid 440, right? So that's the whole benefit paid, 440. But yeah, this 440 we have to split it in order to help us calculate the interest. Okay, so that's it. Then let's do it and get the expected figure. So here we have opening balance of 4,800. The first interest was 144, and the second interest was what? 137.4. Then service cost of 2 oh sorry service cost of 247.8, and then benefit paid. So I think this one should give us a figure of 488. So the expected is 488. 488. Okay. So we have 4889.2. 4889.2. So this is my, or this is the, so this expected value. This is the expected value. So now let's go and compare it with the closing. So what's the closing in the question? So we had a closing liability of the question gave us 4,950. So these are closing liabilities in the question. Yeah, 4,950. So here we will have a remeasurement loss or gain. What will be the remeasurement loss or gain? And here you realize that the liability has um gone up. So we have a remeasurement loss. So we have a remeasurement loss of 60.8. measurement loss of 60.8, and that's it. So here the technicality is with the computation of the interest. Okay, the computation of the interest. So that's it. Where benefit paid out is not at the end, but somewhere midway. That has to reduce the liability before you compute the interest. Okay. Then let's look at the obligation. I'm sorry. Let's look at the asset. Let's look at the asset. So let's do the define benefit asset. So with the defined benefit asset too, we had opening, and it's the same 30. So let me do my control V 1, 2, 3. So we have it in 3 zeros. Okay. Now what's the opening? So the opening asset, so the opening is in the question 410. If you go here, that's the plan assets at the beginning, 410. So the opening is 4.1 million. Okay, so 4,100. Then here too. Now we said what affects the interest. So the next one we have to look at the interest. But here we said with the asset, okay, contribution to the plan will find will affect contributing to the plan will affect the asset. Now I also told you that if the contribution is made at the end, if we pay contribution at the end into the plan, it doesn't earn interest. So you go to the bank and you deposit money at the end of what the year, it won't earn interest for that year. If you had deposited at the beginning, then to earn interest. So here, look at this one question. Here, it says check. The company paid a contribution of what? 680,000 in a lump sum on 1st February 2018. So do you realize that they have paid the contribution into the plan at the beginning of the year? So that will earn interest. So the opening 4,100 will earn interest. And the contribution of 680 was to earn interest for the year because it was paid at the beginning of what? The year. In the previous examples, the assumption was that it was paid at the end. Are you following? So if it's paid at the beginning of the year, then it will earn interest. So this was to earn what? Interest. Are you following? So the 680,000, because it was paid at the beginning of the year, it was earn interest. So here you are computing your interest. Okay. If you are computing your interest, if you are computing your interest, this will earn the 680 will earn interest. So we have to add the 680 to the opening balance. But look at something too. We said with the benefit paid out, how do we do it? We pick an amount from the asset to go and pay the liability. When we're doing the liability, the benefit paid out was what? 420, but it was in division 220 on 31st July 2017 and the remaining 220 on 31st December 2018. Benefit paid out also affects it affects the asset. I follow me. So this how it will be. We said we'll add a 680 to the 410 and the 4,100 because it was paid into the fund at the beginning. It was paid into the fund at the beginning, right? So we said the 680 should be added to the opening because it was paid into what? the fund at the beginning, so without any interest. But see, we also paid out of the fund. We took 220 from the asset on 31st July. We picked that 220 from the asset on 31st July to go and pay the obligation, right? So when it comes to the interest here, the interest will be in two parts. From the same from 1st February, okay, 1st February to 31st July to July. That one, for this period, how much are we going to have in account? Do you agree that it will be the 410? It will be what? The 4,100 plus the 60 plus the what? The 680. That's what will be in the fund from February to what? July. Are you following? Huh. Because in July we took 220 away. So this times 6%, that's the interest rate times the 6%, and then by 6/12 from 1st February to 31st July. That will be 12 months. So sorry, that will be 6 months. So by 6 divided by what? 12, right? And that will give us interest of 143.4. 143.4. Then let's go and compute the interest again. Interest income. Then from August, 1st August to February 2018. 1st August to February 2018. Now, from 1st August 2017 to February 2018, how much are we going to have into the account? Are you following? It will be the same 4,100,000 or 4,100 plus the CCT, okay, into the asset, into account, but minus 220. Because if you look at August, in August, or let's say 31st July 2017, which is the same as August 2017, we paid 220. We took 220 from the plan assets to go and pay the liability. So that should reduce the amount that we are going to have in account from August 2017 to February 2018. So this is how it will be. Then by 6%, so this 6% times that's also 6/12. So August 2017 to February 2018. So that'll be 6/12. Okay, and then that should give us 136.8. 136.8. So that's it with the interest. Then we have, okay, so let me carry this one down. So that's it. Then we have, so that's it with the interest. They have contribution to the plan. So how much is the contribution to the plan? 680. The whole 680, and we said it should be what? Added 680. Don't forget that we didn't add it here. This is 80. We just added it to get the interest because it is made at the beginning. So we expect it to earn interest. So with the contribution, we said we expect to we brought it at the beginning because we expect it to earn what? Interest. Or when we're calculating the interest, we added it, right? So that's not the real amount. We just added it to get the interest. Then benefit paid out we said will also affect the asset. So benefit paid out is not the half, it's the total benefit what paid out for the period. Okay, so benefit paid for the entire period, how much is it? It is 440, the total 440, right? Okay, so that's it. So we had the what? The 4,100 plus 143.4 plus 136.8 plus contribution to the plan 68 minus 44. Okay, benefit paid out is 440. 440. Okay, benefit paid out is 440. And then let's do it and get expected. So we are going to have expected of 46 4620 4620.2 4620.2. So this is the expected value. This is the expected. Then let's compare with the closing. So the closing is now here the asset. The question didn't give us any closing figure for the asset. The question did not give us any closing figure for the asset, but we've been told that. So this question is a bit complicated, very complicated, but not really. We've been told that, see, there's a return here. It says, and the actual return on the planned asset was what? 282. That's the actual return, 282. Are you following? The actual return is what? 282. But look at it. When we computed the asset return, come here and come and see the actual return, the asset return. Okay. Come and check the asset return. If you come to the asset, what's the return or the interest? It is what? The 143.4 plus what? The 136.8. So this figure here and this figure here, these are the interest we've computed. The interest on the asset. That's the return on the asset, right? So it's the 143.4 plus what? The 136.8. If you add the two interest, what do you get? You get 280.2, right? 280.2. So the return on the asset is 280.2. Are you following? 280.2. But we're told that the actual return on the asset, that's what they gave us here. They said the actual return, the actual is 282. Now, do you know that this return that this interest that we computed here is based on the opening, which the opening we said is by the actuary. So if you look at the interest computed in the question here, it was based on both the opening and then the payment to the plan. So in a way, it's not actual, but it's actual. Like this is what I mean. You see, we computed the interest based normally on the opening balance plus the payment to the plan. And we say the opening balances are normally done by what? The figures, they are done by actuaries. It's like a projection or estimation by the actuaries, right? But they said the actual return on the asset, so the investment interest they got when they invested the amount, when they invested the plan asset is 282. So that's the actual. Maybe they bought some bonds, they invested in banks and stuff. And that's the actual they got. So this A2 is the actual, but per our computation, okay, which is based on the actual values. We got the sum of what? The 143.4 and then the 136.8. And that gave us what? 280.2. So the difference between the actual, the very actual they've gotten, okay, and the one we computed. So the difference between, so our remeasurement figure here, okay, so here we are not giving the remeasurement, we have to do it ourselves. In OCI will be the difference between what the actual given in the question and the interest we've computed and the return we've computed, which is what? The 280 point what? And you know how we got the 280.2? It's the sum of the 143.4 and the 136.8. That's what gives us the 280.2. So the difference between that one is our remeasurement value. And here you realize that it is a gain because the actual is more than our expected, right? So the 143.4 and then the 136.8, the summation of the two is expected because this thing that we are doing here, we said is expected here. Are you following? So the actual interest income, which is the 282, and then the interest we computed using the quality bonds. I mean, using the applying the 6% on the opening and then the addition. Okay, so we had a gain because the actual was more than the expected. Okay, so we had a gain of what? 1.8. So there'll be a gain of what? 1.8 because the actual was more than the interest we computed. The 280.0 that we computed, the actual interest was more than that. So we had a gain. So in this question, we will not be given the closing figure. Are you following? So we have to do it, add this, the remeasurement gain, and we said this again. So add the remeasurement gain to the expected value here, and then we will get our closing balance. So here we've not been given a closing balance. So the closing balance will be the sum. Okay, we said it's a gain, so we are adding. So when we add, we get 4622. 4622. That will be the closing balance. So just know that in this question, we've not been given the closing balance. So we have to compute it ourselves. Right? So that's it. So here, that's how we got the remeasurement loss or gain. Okay. You have to compare the actual return on the asset, okay, with the return that you've computed. And you realize that the actual return on the asset was what? The 282. And then what we computed, the summation was what? 280.2. So the actual was more than what we computed, the expected. And so we had a remeasurement what gain of 1.8, and that'll be taken to OCI. So when you go to your statement of let's go to our statement of profit or loss and other comprehensive income. Okay. With the statement of financial position, you know what we are going to record. Okay, we are going to record a figure of 328. 328. And this is how we got the 328. We said we compare the closing asset and the liability. So here the liability was what? 4,950. That's the closing liability. The closing assets was 4,622. So you'd realize that the liability was more than the asset. The liability was 4,950, and then the liability the asset was 4,622. So the liability was more than the asset. So we have a net obligation of what? 328. So you record that in the statement of financial position as non-current liability. So you'll be doing the extract as I explained. Then when you go to profit or loss, you know the figures we'll record, right? We'll record interest, cost, and income. But if you look at it, we did the liability first. The liability, if you sum the interest, okay, if you sum the interest, that is the 144 here plus this 144 here plus the 137.4. If you sum it, you sum the two, okay. If you sum the two, you get 281.4. So that's the total interest cost. I follow it. 281.4. So that's the total interest cost. So 281.4 as interest cost. And then let's come to the interest income. The interest income, the summation of these two, the 143.4 and the 136.8. That will give us 20 and 280.2. So 280.2 is the net income. So 281.4 minus the 280.2, you get what? 1.2. So 1.2 is what we are going to record as interest expense. And that one too, you realize that the expense was more than the income. So in the P&L, you record interest expense of 1.2 and the service cost. What's our service cost from the liability? Service cost was what? 247.8. So these are the items that will go to the P&L. 247.8 as current service cost, and then the net interest 1.2. Okay. Then if you go to your OCI to the same thing, your remeasurement loss or gain, your remeasurement loss or gain, your remeasurement loss or gain. So the losses, let's see, when we're doing the liability, we got a remeasurement loss of 60.8. This figure here, 60.8 remeasurement loss. Then if you go to the asset, we had a remeasurement gain of what? 1.8. A remeasurement gain of 1.8. So if you net it, the two, you get 59, and it's a loss. Okay, so remeasurement loss in OCI 59. Remeasurement loss of 59 in OCI, right? So that's the extract and the end of this video. So with the reconciliation, well, we will look at it, but that will be for, let me see, students of professional bodies, maybe students writing the ICAG, ACC and stuff, right? We'll look at the reconciliation, but that's basically that's what we've done. Okay, so the reconciliation is basically like the net. That's all. The net will be the reconciliation. Okay, so just put your stuff together, and that will be the net. The net will be the reconciliation, because you have to reconcile the opening with the closing, right? So that's it with this question, and that's the end of this part 2. So that's the end of this session of the question and answer session. I'll see you in the next video.